Ladies and gentlemen, good day and welcome to Schaeffler India Limited Q3 CY22 earnings conference call. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Ms. Gauri Kanikar from Schaeffler India Limited. Thank you, and over to you, ma'am.
Thank you. Good day, everyone. Thank you for joining Schaeffler India Limited's earnings conference call for the third quarter and 9 months ended 30th September 2022. We have with us today from the management Mr. Harsha Kadam, our Managing Director and Chief Executive Officer, and Mr. Satish Patel, our Director of Finance and Chief Financial Officer. Mr. Kadam will first take us through a short presentation on the results, after which we open the floor for questions. Thank you, and over to you, Mr. Kadam.
Yeah. Good evening, this is Harsha Kadam, and I'm joined with our CFO.
Hello, good evening, Satish Patel here.
Well, let me start by briefly taking you through the presentation, and I hope all of you are able to see the slides. I am on the first slide, where I will be covering the Q3 performance and the 9-month period as well. I move into slide number 2, where I would be throwing light on the economy and the industry. Then I would talk about the business highlights for the third quarter and the 9-month period of 2022. I would then move on to cover the financial highlights of the third quarter and the 9-month period of 2022. And then a couple of topics on which I would like to throw some lights as well. Moving on, I move to slide number 3, where I would like to touch upon the economy and the situation in India. And as you can see from the chart on the slide, the GDP growth, which posted a very strong number in the second quarter of this calendar year at 13.5%, moving into the third quarter. With the prolonging war in Ukraine and the tightening up of the global monetary policy and also the imposing of the economic sanctions is certainly weighing down heavily on the economic outlook in India as well. As you all know, the World Bank has already downgraded the GDP forecast for the current fiscal year to 6.5%, which was in the earlier forecast was 7.5%. With both the international headwinds and the domestic headwinds, coupled with the growing international inflation as well as the domestic inflation, India is already feeling the impact in some of the sectors, and that surely is also reflecting on some of the sectoral performances within Schaeffler as well. One in case is the wind energy sector, where a number of our customers have cut down their export orders due to the pressures on the ongoing situation in Europe. Also, the wholesale price index, which is at a double digit and twice that of the consumer price index, also points that while the credit and liquidity stimulus packages are in place, the retail inflation will continue to be there for some time. With all this, the forecast numbers of 6.5% of GDP growth, the index of industrial production, which is very subdued in the third quarter, provisional number being at 0.7, we have seen some uptick in the automotive production in some of the sectors, while some of the sectors still have not picked up. All this points to a situation that the third quarter we had some subdued demand situation in the country as such. I move to the next slide, where I would like to give some more details based on each of the sectors. And what you see on the slide number 4 is the sectoral performance in the industrial space. When you look at the cement production in the country, month over month, the first quarter of the year, cement production was at its highest. But when you look at the third quarter, you would see that gradually there is a production drop that has happened in the third quarter. While at an year-to-date level, you still find that cement production is 10% better than the same period last year. When you look at coal production, it is a lot more evident that the first quarter was a very strong performance in coal production, averaging about 85 million tons. When you look at quarter three, that has already come down to close to 55 million tons averaging in the quarter. But still, because of the strong performance in the first quarter, at a year-to-date level, it is still showing 14% higher production rate of coal in the country. Top of steel, which contributes almost 18% to the industry, you would find that the steel production too has remained more or less at the same level as last year in the third quarter. The power generation, which is another strong indicator, which contributes close to 20% weightage, and you will see that even the power production or electricity production in the country in the third quarter has reduced marginally. With all this, yes, there were quite a few challenges and headwinds that we have been facing. Let's now look at the auto sector as to how it has performed, and for that I move into slide number 5. I'm on slide number 5, and here again what you see is a little different picture. The overall 2 and 3 wheelers had a subdued second quarter performance, but when you look at the quarter 3, the numbers have started to pick up, and the 2 and 3 wheeler sector, which was in a negative numbers posted last year, you will find has rebounded back with a 4% better performance at a year-to-date level. Look at the passenger vehicles, and the same you would find strong growth in the third quarter in the passenger vehicle segment, and a year-to-date level, posting a year-to-date level of 22% better than the last year's performance. Commercial vehicles started off on a strong trajectory in Q1, but when you come into Q3, the numbers are a little lower than Q1. One of the sectors where there was hope and anticipation that it is going to recover has also started to show some small signs of recovery, and that happens to be the tractors. For the first time in many months, we are seeing the tractor numbers pick up marginally, but an overall year-to-date level, it is still below 9% below when compared to the last year. With this situation, clearly, when one were to look at the numbers and compare that with the 2019 numbers, what it was, and we still see that we are not even there at the 2019 levels. However, some of the sectors, as I already said, is showing positive signs of recovery. And going forward, I move to the next slide, which is slide number 6. And I move to slide number 7, sorry. And there I would like to give a picture on what happened in the third quarter of 2022 when it came to Schaeffler India. Despite all the challenges that we had in the market environment, and our sustained performance was due to the fact that we have a pretty balanced portfolio mix between the auto and the industrial sectors. Not to mention, of course, both the sectors have tried, and automotive has been definitely we have posted much better performance, while industrial for the quarter was a little below the same period last year. I'll come to that in a while. While with all these challenges, we have managed to sustain and hold our financial performance and have been able to deliver the margins, as you can see on the boxes on the right side. We continue to keep our focus in engaging with our customers, and as you know, in every earnings call, I do share the new business wins and the new initiatives that we take up in actively engaging with our customers. And this quarter as well, we were able to launch the Rep Expert, the mobile technical training van in the automotive aftermarket space. I will cover that in my succeeding slide. One other highlight is the corporate governance scorecard, where we went through an evaluation process, and we continue to remain in the leadership position, which I will throw light further down in my slides. We do believe that the headwinds what we are facing on the global market and the outlook as well as the inflation would continue to dog us for some more quarters to come. However, with all these challenges, we have been able to post a reasonably good performance in terms of the sales growth. As you can see, we were able to post 18.1% higher sales revenue over the same quarter last year. But over the preceding quarter, as things have got more challenging, we were able to just post 0.4%, clocking in 1,756 crores for the quarter this year. This resulted in an EBIT margin of 15.7% for the quarter, which definitely, as you can see there, is better than the same 14.9% that was there in the same quarter last year, bringing in an additional 275.6 crores to the bottom line. The profit after tax margin stood at 12.3% compared to the 11.5% of the same quarter last year, and bringing in 215 crores to the bottom line. We did face some challenges on the free cash flow within the quarter, and we were 33.5% lower when compared to the last year same quarter period. This is clearly attributable to the cash flow issues that we are facing, as well as some of the inventories that are piled up as well, the working capital as well going up. I move to the next slide, slide number 8. Would love to share with you some of the new business wins that we have secured within the quarter, be it in the automotive technology space. We were able to secure some business wins in the commercial vehicle sector for the double clutch systems, not to mention, of course, some of the needle roller bearings and the ball bearings in the passenger vehicle segment as well. Talk of the automotive aftermarket, while we had no new product launches, but however, of efforts to consolidate our growth trajectory in the new products that we have launched in the previous earlier quarters continues, and we have been able to secure volume wins for the newly launched products. As well as the point that I shared, we have started to engage with the front-end mechanics and the garages to ensure that we create the pull for our products from the market side through the rep expert effort that we are putting through. And the traded goods that we have launched in terms of shock absorbers, lubricants and wipers, we continue to expand our market presence as well as the reach, and the consolidation process continues to go on. On the industrial side as well, we have secured some key businesses for the cylindrical rollers, the spherical rollers and the taper rollers in our off-road segments. Not to mention some of the large size bearing in the energy segments that we have bagged some good orders, as well as the linear guides, the quick center that we have put up has managed to rope in big orders from our industrial automation or machine tool industry customers, and which is further augmenting the demand situation which we see weakening in some of the other sectors. Having said that, I move to the next slide to throw some light on the rep expert. And what you see here is a van which is self-contained with all the training modules, hands-on training that is given by our expert engineers in the field. And this was officially launched on the 7th of September this year. And the plan is to cover roughly 9,000 kilometers across the country and addressing 1,100 garages. And for 81 days, this is going to be on the road. We're going to run training sessions for the repair garages, for the fleet workshops, for even the multi-brand garages and the retail markets as such. And in all, we would be covering about 36 cities in all to ensure that we extend the reach further into the marketplace. With this, I move to slide number 10, wherein I would start to talk about the financial highlights. I am on slide 11 now, and looking at the revenue from operations, we have sustained our performance in terms of sales revenue in the third quarter in spite of the challenges that we are facing both on the domestic front and the global market situation as such. So as you can see, with 1,756 crores that we have posted in the quarter, which is a clear 18.1% over the same period last year. However, as I earlier said, 0.4% over the preceding quarter. Now, if I were to compare the revenue bridge as to how did we move from last year to this year, a lot of contribution has come in terms of the volume growth from the auto tech space. As you can see, 157 crores for the quarter coming in from the auto tech space, and the rest coming in, a large part of it coming in from the export businesses, which is another 107 crores. Another 5.5 crores coming in the automotive aftermarket space. Industrial was the only sector where we had a dip in the sales revenue for the quarter, coming on the back of some of the weak demand in the wind sector and some of the steel raw material sectors. If I were to compare the sectoral, performance over a 9-month period, I refer to the chart on the right-hand upper corner there. When you look at the year-to-date period, you would find the automotive technologies, in spite of the weakening growth in the first quarter and now a recovery that we see, still able to post 23.9% better performance for the same period last year. The automotive aftermarket grew by 21.4%, and industrial, with a strong first quarter start but a weak third quarter, we still are at 17% better performance than the same period last year. Exports, on the other hand, which is clearly a focused strategic direction that we have taken. As you can see, we sustained the growth at 62% over a 9-month period as well. So I talk about the balanced portfolio of the business that we are able to, drive in the marketplace. And as you can see, with the changes that we are seeing in the quarter, our automotive technologies contributes 41% to the sales revenue, while the industrial contributes 34%. And our exports, we have been able to sustain this in the last 3 quarters at 15-16% level. And the automotive aftermarket takes the share at 9% of the total sales revenue. With this, I move to the next slide, which is slide number 12. And here I would like to touch upon the earnings quality for the quarter. And as you can see, as I said earlier, in the third quarter, we were able to bring in 275.6 million as the EBIT value at a margin of 15.7%. And this was clearly a 24% better performance year on year. Even after a 9-month period, as you can see, the EBIT margin for 2022 still stands at 16% compared to 13.7% over the same period last year. If I were to look at the EBIT bridge as to where did this margins come from, straight volume increase, gross margin improved 925 million or 92.5 crores. And we did have some smaller improvements in terms of employee cost, in terms of other incomes, and taking the total to 275.6 crores for the quarter this year. This resulted in a profit after tax coming into quarter 3, as you can see, at a 12.3% profit after tax margin, which is a clear 26.1% better performance at a year-to-date level and a year-on-year growth performance. If one were to look at the 9-month period performance, profit after tax stood at 12.8%, and the same period last year was 10.9%. I move to the next slide, which is slide number 13, which throws some light on the working capital development and the capex. So with the subdued demand that we saw, we did definitely see some increase in inventory levels. Hence, you see some marginal increase in the inventories in the third quarter compared to the preceding quarter. However, at a 9-month period, as you can see, also the working capital as a percentage to sales stood at 19.9%, The same period last year was 18%. One point which I would like to tell here is the volume growth obviously needs to be serviced as well. So some part of the inventory increases and the working capital increases was already factored in to ensure that we sustain the service levels to our customers. When we look at the capex spend in the third quarter, close to 100 crores was spent in the quarter alone. And as you can see, our clear, focused, consistent investment effort that we have been doing every quarter continues. And as a percentage to sales over a 9-month period, this year we are at about 6.2%. And if one were to compare to last year, which was around 3.5%. I did mention about free cash flow in my earlier slide that this could have been a better picture here. We are making efforts to ensure that we recover the lost ground in the third quarter of this year, in this coming quarter, and thereby get in line with the targets that we have set on the free cash flow as well. I move to the next slide, slide number 14, which is throwing some light on the key indicators and the key figures. I did already talk about an 18.1% growth in sales revenue in the quarter, and if one were to look at a 9-month period, clearly a 25% growth over the same period last year, and this resulting in an EBITDA margin of 19% when compared to the 17.3% of last year. Rightfully, the EBIT margin closing in at 16% at a 9-month period compared to the 13.6%, and this resulting in a profit after tax margin of 12.8% compared to 10.9% over the 9-month period. And as I said earlier, capex spend, as you can see, for the 9-month period has been 316 crores, which compared to last year, the same period stood at 136 crores. With this, I move to the next slide, and I would like to touch upon a couple of highlight points. I am on slide number 16, and I would like to talk about we went through an evaluation by the Institutional Investor Advisory Services. We had gone through this process way back in 2019, and clearly, given that India is a member of the G20 forum, this evaluation framework is built around the G20 and the OECD principles of corporate governance, which is a globally accepted benchmark practice for corporate governance. And we went through this process of evaluation by IIAS, and I'm very happy to share that we have sustained, if not bettered or marginally bettered, our leadership position by scoring 76 percentage points. The same number last time we went through the process, we were at 75. And this is a clear commitment from our side that we will continue as an organization and as a company, emphasizing that we are very committed to high standards of corporate governance, and we will continue to keep our focus on corporate governance. Having said that, I move to the last slide, which is a summary slide. And here what you see is our revenue performances in spite of the sluggish macroeconomic demand situation as well as the local inflationary domestic situation. We have sustained our performance, and we will continue to make efforts to better this in this quarter. Our balanced mix obviously has, and the countermeasures which we have continued to sustain in the last quarters, has enabled us to deliver the margins in spite of the headwinds that we have faced. The capex, which is on track as per our commitment and our strategy, we continue to ensure that we consistently deploy capital judiciously. And while we will remain cautiously optimistic in spite of the weakening global demand as well as a lot of unpredictability and uncertainty. With that, I come to the end of my presentation. I open the floor for question and answers.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and one on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. A reminder to the participants, anyone who wishes to ask a question may press star and one at this time. The first question is from the line of Mukesh Saraf from Spark Capital. Please go ahead.
Yes, sir, good evening, and thank you for the opportunity. My first question is on the revenues. You did mention that the industrial segment revenue is kind of weak because of the wind energy segment. But I'm just trying to get some sense on, how do you see the future? Because wind probably is not that large in the overall scheme of things for us. Do you see some other segments offsetting that in the future, especially with the private capex in the country going up with the PLI schemes, etc.? Could you give some sense on how this industrial segment for us can pan out?
Yeah, thanks, Mukesh, for the question. Yes, as you said it right, we have seen the export of wind equipments from the country has become subdued fundamentally on the back of the sanctions that are getting imposed in Europe and the rest of the world. So having said that, what we have seen is all the wind equipment manufacturers who use India as a manufacturing base and export out of India, we have seen the demand going down as such. Now, is this going to remain? I believe yes, considering the fact that with the sanctions going to be there until they find a different way to channelize the products that have to go to those countries. I believe that yes, we are going to face headwinds in this sector for some more time to come. However, we do also see that the domestic demand for wind still continues to be there, albeit it is not at the same high levels that used to be there in the export market. But we have not seen a drop in demand for the wind equipment, nor the products that go into the domestic wind equipment supply. So we believe, to summarize, that yes, this headwind would appear to remain for some more time.
Got it. And in relation to that, I mean, given that export is kind of weak because of the global macro situation, we have still seen exports for us, the direct exports for us, still holding on strongly at like 60% growth YOY. Is there a reading here for us that this exports, here might not sustain at this level in terms of growth because of this global situation already impacting, say, the wind segment?
All I can say, Mukesh, at this point in time is our third quarter, the exports, our own exports, did pretty well. And we see the order books even in this quarter pretty good. So we see no signs of concern for this quarter as well. As you know that this export is being done clearly with a very clear strategy and investments accordingly in line with that, plus the relocation of the productions happening, all of this put together, at least for this quarter as well, we do definitely see no cause for worries in our own exports.
Yeah. Satish Patel here. Yeah, just one more point to add as regards the exports is the 1.3% growth that Harsha mentioned in the quarter for exports and others. If you look into the real export growth, because this total 1.3% includes other revenue as well, and other revenue has declined by about 15%, which is small in proportion. Exports actually grew by over 7% quarter on quarter. In a way, export there is a growth. Yeah, the revenue decline is because of the timing difference of scrap disposals and such things. But when we talk about exports, there was really a growth of about 7% for the quarter.
Got that. And just last one, if I may just squeeze in on the margins. We're seeing a couple of things playing out here with OEM revenues going up, aftermarket kind of flattening out, and obviously raw material cost, steel, etc. coming off. So how do we kind of look at margins with these things playing out, where OE mix might actually impact margins, whereas raw material might actually benefit margins? Do you think directionally there is kind of plateauing out in terms of the improvement in margins from here?
As far as margins are concerned, for the quarter, margin is reflection of the mix as well as the cost level sustenance of the previous quarter because the steel price actually did not increase beyond what already increased in the preceding quarter. In terms of how the margins would look forward, in terms of sustainability, certainly would depend upon the mix going forward for both the businesses, automotive and industrial, as well as aftermarket and the exports. We are quite confident that the cost level in terms of the level of countermeasures and the cost discipline that we have brought in, that would continue. However, we still keep our fingers crossed with regard to the steel price and the inflation that might cause some impact going forward. As of now, we do not see, because the current quarter, there is a little sort of a reduction in the increase of the steel price and inflationary impact not significantly impacting the overall performance so far.
Right. Great. Thank you so much. I'll get back in the queue. Thanks.
Thank you.
The next question is from the line of Rishi Vora from Kotak Securities. Please go ahead.
Thank you, sir, for taking my question. Just a follow-up on exports. You did highlight that there is some relocation of export that is happening maybe from abroad to India. So can you just elaborate on that, on what is happening? Is parent shifting increment? Is Schaeffler India winning incremental orders? Is also parent looking to shift more capacities in India over the medium term?
Yeah, so as regards exports, we had also mentioned in the previous call last quarter that there have been certain relocation programs, and those are progressing as per the plan. So those relocations have been in progress, and that is one of the contributor of actually increase in the content of exports in the total pie. With regard to the overall demand situation, yes, there would be certain impact coming from the global scenario, but that is unlikely to impact the level of performance that we have achieved in exports because large amount of that is actually comes from the structural aspects of relocations. Coming to your specific question about relocation, yes, those are on track, and we are expecting, in fact, those to progress also as per the plan. We have also earmarked specific capex for exports for those relocation projects as well as further capacity expansion in CRBs and similar other type of products, and the capex is also on track. So we are expecting capacity also coming out of the plants for exports.
Sure. Thank you for that, sir. And secondly, on RM, so from fourth quarter, from this current quarter, do we expect RM basket to cool off, or you expect that it will still remain at a flattish kind of a level? And on top of that, additional question is on how are your accounting, what is your agreement with OEMs in terms of RM pass through? So do you make a fixed percentage point margins on your product, or you make a fixed cost profit for bearing supplied to your end consumer, at least on the OEM front? So any color on that would be helpful.
So I think your question is in two parts. One is the impact of the steel price in RM and the how long this would be there. So far, how much and how long. The second part of the question was related to how we recover from the market. As regards the impact in RM, so far there have been sort of a quite significant impact. Largely came last year already. And that impact continued. Whatever happened last year continued this year. Additionally, there were further steel price increases in this year. However, in this quarter, there have not been any further increase. So that is a good news as far as the quarter is concerned, that there have not been increase, and for at least another quarter, we are not expecting increase, though it depends on several external aspects. Coming to the recovery, it would be very difficult to provide you a detail how exactly we recover, but in general, we can comment that we do have a strong recovery mechanism, both in terms of indexation as well as negotiation, and we have been able to actually so far persuade our customers in the market to accept and pass on the steel price or the significant input cost increase. This does happen because the input cost increase is significant, quite material. It is not in the normal range, and this has been situation across the industry. In fact, our customers have also been able to recover from the market. As you would have seen, the prices of the end products, automotive vehicles, have also been increased in the range 2 to 4%. And one of the major elements for this is actually the commodity price increase. So it is across, and yes, we in the supply chain have been able to, in a way, recover quite a significant portion of that.
Just one clarity, sir. On the RM front, steel prices have corrected, over the last 2 quarters, and still in fourth quarter, you are saying that RM will kind of remain flattish. So, is it that we have some inventory still there in the system, and that's why we expect RM basket to remain flattish, or is there is some other factors which is resulting in a flattish RM basket?
So the inventory turnover is quite fast for that category of raw material. So it is less than a month actually. So it is, whatever happens in terms of the price does impact, whichever direction it moves, does directly impact the quarter.
I just want to clarify, Rishi, here that it is not that the steel prices have reduced. It is just that the rate of steel price increase, which was there in the earlier quarters, has reduced. It used to be in double-digit increases. Now it has come down to a single-digit increase, and that's the difference.
Okay. Understood. Thank you.
Yeah.
Thank you. The next question is from the line of Sonal Gupta from L&T Mutual Fund. Please go ahead.
Hi, good evening, and thanks for taking my question. So just on the export side, wanted to understand in terms of your contracts, are these euro denominated? I mean, do we have any FX related currency risk?
Large chunk of our exports happen in euro currency. And there are also 2 categories or 2 types of transactions. One is directly in euro currency, other is in INR currency, because we do have imports as well, significant imports in euro. And on the imports also we have imports both in foreign currency, which is in euro, as well as in Indian currency, which is INR. So because of this sort of a currency impact, because of the rupee currency and also because of the natural hedge, the volatility which is there in the currency is more or less neutralized. The impact of that is neutralized. But yes, we do have higher chunk of our transactions in euro than any other currency.
Got it. And on the RM side, for these exports also, do we have a pass-through?
Yes, RM is a global impact, be it imports or exports or domestic consumption or domestic purchases, is all around, and all whatever is the impact.
I think
we have been able to
that exports we don't directly
clear.
We don't directly sell exports.
Exports. Yeah. Our exports are to our group companies. Our group companies in turn sell in the market. Yeah. However, the steel price impact globally
is factored in the cost.
Factored in, yes. That's what the clarification that we wish to provide.
Got it, sir. And just lastly, given that we have seen a significant bump up in capex as per your guidance. I mean, this year we are seeing clearly a significant increase in capex. So I mean, do we see that we should start seeing a big lift in revenues next year from the investments we are undertaking?
Actually,
yeah, large chunk of capex is for capacity, and capacity would mean higher generation of output and thereby revenue. Yes, that goes obvious without saying. And we have been on track so far on the capex. We also announced that we would be spending over 400 crores this year, and we are very much on track.
Yeah, no. What I was trying to understand is that the installation time and the ramp up time is like 12 to 18 months, or is it longer than that? That's what I was trying to understand.
No, you said it right. It's about 12 to 18 months, and the projects which we are already on track, we anticipate next year one of the projects to culminate into series productions to start. So the other one is at a little start stage right now. So I guess, yes, 18 months is the best estimation.
Got it, sir. Great. Thank you so much for taking the question. Thanks.
Thank you. The next question is from the line of Sandeep Tulsian from GM Financial. Please go ahead.
Yeah, a very good evening. So my first question is pertaining to the QOQ growth that we have reported. The numbers are largely flat, while given the steel price increase that we would have seen, as per the standard practice, we would have passed it through in terms of segments, where there's indexation as well as aftermarket, where it is company dictated prices. So if you could break down what kind of price hikes you have rolled out over the last 2 quarters, and if we factor in some basic price increase of even low single digits, it assumes that there would have been a sequential volume decline sequentially. So is that a correct assumption? If you could share some more insights on that.
Sandeep, if you can clarify the last part of the question. Sorry, we couldn't get that.
Yeah, apologies. So basically, if we look at the sequential growth, sales has remained flat. Even if you assume a nominal price increase company would have taken in low single digits, it implies there was a volume decline overall on a sequential basis. So if you could highlight the key reasons for same.
Yeah, so to answer your question, when you compare quarter 3 vis-a-vis quarter 2, both the quarters have recovery.
Yeah.
So therefore the growth, whatever minimal it is that you see, is actually the volume growth as well, because both the quarters have the impact of the recovery. So because of recovery taking out, you would not find decline in volume.
Sandeep,
because you would take out from both the quarters, correct, and then there would still be increase in the performance in the revenue, which would be because of the volume.
Correct. Our recovery effort continues.
Yeah,
whatever is the case. But this is what we see is the big impact is due to the slowdown in some of the sectors, wind and the raw materials. We have seen a bit of slowdown, predominantly on the industrial side. Even tractors, we saw some drop. So these have contributed to the top line being flat when compared to the preceding quarter. But the steel price, whatever it is, those recovery efforts parallelly are going on.
Understood. Second question is pertaining to the auto aftermarket. If you look at the quarterly run rate over past 5 quarters, it's largely been around that 150 crores per quarter revenue that we are doing. And in this meanwhile, over past 5 quarters, I'm sure there would have been significant number of price increases that have gone by. Plus, we have expanded our product basket, including lubricants and other products as well, which we have been highlighting every quarter. So why this segment is stagnating at this current level? How should we look at the growth in this segment? Where can it increase to? What are the key reasons why we are not able to expand? Any dealer expansion issues we are facing? If you could give some perspective on this piece of auto aftermarket.
Well, first, let me, make 2 points here. The automotive aftermarket has a business cycle of its own. That is one. So you would normally see when you look at the trend quarter on quarter, you will find the last quarter of the year being pretty strong in terms of demand as well. That is one. The second is a point I wanted to make was more to clarify that the automotive aftermarket top line has not been flat. It is only, if you were to look at the second quarter performance over the first quarter of this year, you would have found 20% growth we have demonstrated. So now the third quarter over the second quarter is just about a percentage point more. And we anticipate that the last quarter of this year definitely should be much stronger as such.
Okay. No, but I was more over looking at the trend over past 5 quarters. It's averaged at 150 crores. So it has not grown on a year-on-year basis as well. So that was the point of asking that question.
Well, the numbers I'm looking at, Sandeep, is last year the average used to be about 125 crores a quarter. If you look at
last year, second half of last year, what I'm implying. Okay. No, fair enough. I kind of get the point that it's lumpy and there might be some fluctuations on quarterly basis. Last question, if I can squeeze in, is on the content per vehicle, which we have been highlighting that the content per week from 40 euros per vehicle to 80 euros that remains, where we are in that cycle. And in previous call, you highlighted that the companies are taking some particular orders at subsystem level. From component level, we are trying to move up in the value chain. Give some examples where we have been successfully been able to convert. What would this do to our overall content per vehicle target? How should we look at this entire transition? That's my last question.
Yeah, as I said earlier, the content per vehicle, we have a clear plan to grow the content per vehicle, and accordingly, there are products which we are bringing, which are moving into the subsystem level, and that is happening. And some of the new business wins in terms of our transmission business, which you see recently that we have secured on the DCT or the dual clutch transmissions, you will find exactly moving in that direction to improve the content per vehicle offering. What I would like to also point out is these could vary. The content per vehicle varies between the segments within the automotive space. The light commercial vehicles, the heavy commercial vehicles have different content per vehicle, and depending on the products we have and the offerings we have, and the new business wins that we make, clearly determines what's the content per vehicle. So we have varying content per vehicle, growth happening in the different segments, so to say. Tractors, we were having the dual clutch was a growing market, and if one were to look at the quarter 3, the demand for dual clutch actually went down because the specific models were not being produced in that quarter. So that had an adverse impact on the content per vehicle in the tractor segment. Whereas in the others, we were in a much favorable situation where we have grown a bit. So you have a varying mix coming out when we look at the content per vehicle.
Understood. Thank you so much for taking the questions.
Thank you. A reminder to the participants, anyone who wishes to ask a question may press star and 1. The next question is from the line of Manjeet Buaria from Solidarity Investment Managers. Please go ahead.
Hi, am I audible?
Yes.
Okay. Thank you for taking my question. I had one question which relates to the exports business for the company. When I read the call transcripts and management communication before July 2020, what was explained was Schaeffler globally has a philosophy that every region has its own, manufacturing facilities for those regions. And it was expected that exports out of India will remain at 8 to 10% of company sales for the India entity. So I just wanted to understand what has structurally changed over the last 2 years, where this kind of seems to not hold anymore, where exports suddenly has become a big opportunity for us, and even the parent seems more okay with us exporting more out of India for other geographies versus localizing the manufacturing. Thank you.
Yeah, so your point is very valid. Couple of years back, we would have said that exports would be in the range of 10%, and Schaeffler does have strategy and philosophy of producing in the quarter for the quarter, and that remains unchanged. Even now also, that strategy philosophy remains unchanged. We do have sort of a production in the quarter, in the region for the region, and this is obviously because of the content of the steel in the raw material, which is A category cost, and that remains above 50%. So, and the price level of that is not significantly different across the globe. However, during those calls in those years, we have also mentioned that as a strategy, Schaeffler also focuses on products for the country where there is a critical mass and west. And carrying that story further, we have in subsequent calls also clarified that as far as India is concerned, there are certain products where India has a critical mass. India can serve the other global Schaeffler countries, and also the competence exists in India. Cylindrical roller bearings and certain other type of bearings was a very good example. In addition to that, when Schaeffler did the global sort of a review of the strategy, it was actually found appropriate that in other countries, this type of products are in not so much of critical mass and requires to be relocated to India. And the second was, in addition to the competencies, also the cost. For certain products, we have developed the cost competence in addition to the engineering competence, and that actually makes also relocations quite feasible. So that is the main focus. In addition to that, yes, one more point is that some of the markets which were not so much accessible in the past have actually opened up more than what were there in the past. And one good example is the Asia Pacific. And in Asia Pacific now we have quite a high ratio of exports, inclusive of all the South Asian countries, Southeast Asian countries, and also in China. So that has also some more opportunities unlike in the past.
Thank you. I have one follow-up question, sir. If we take this total pie of products where India stands out either for cost advantage or critical mass advantage or for some, technology advantage, everything put together is globally the pie is 100 for Schaeffler, our parent. What % of that are we supplying right now? So I'm just trying to understand our penetration for these products where we have some edge in the global scheme of things.
What's fine?
Yeah, I do not have that. I understood your question, but I do not have that sort of number ready.
Yeah.
But yes, where we have the competence, actually the contribution of our exports is significantly higher. So it is significantly higher. So I would say it can range in 30-40% of the global requirements, at least 20% of the global requirements. But I would not be able to give the exact number for those products. I don't have that data in front of me. But yes, wherever such CRVs, for example, the contribution of Schaeffler India is significantly higher.
Right. And one follow-up final question, if we take really long-term perspective, a decade, 2 decades, can this structurally go up to like 60-70% of global contribution for parent, or are there certain strategic reasons why for which the parent would not want our shares to be so high? Thank you. That was the last question.
No, there is no limit. There is no limit to that. I mean, as long as we are able to sort of sustain that level of competence both cost, engineering, and technology, and able to serve, I think there is no limit. However, how much would that be? That would be very difficult to answer.
Thank you.
Thank you. As there are no further questions from the participants, I would now like to hand the conference over to Ms. Gauri Kanikar for closing comments.
Thank you, everyone. Thank you for joining us today. If you have any further queries, please do reach out to me on gauri.kanikar@schaeffler.com. Thank you and have a good day.
Yep. Thank you all.
Thank you.
Thank you. Ladies and gentlemen, on behalf of Schaeffler India Limited, that concludes this conference call. Thank you for joining us, and you may now disconnect your lines.